Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen & Partners, to our sixth weekly update on global strategy and the progress of the COVID-19 virus. Starting on slide 2, you will see the progression of cases around the world using the format that we've adopted throughout these presentations of the number of days since 200 new cases appeared in 1 week. In other words, the virus got hold. You can see that across the European regions, we are broadly rolling over, albeit slowly. The red arrow shows the blue line, the UK, I'm afraid now the peak in Europe. That was to be expected. The WHO Director General put it well, most of the epidemics in Western Europe appear to be stable or declining. Although numbers are low though, we see worrying uptrends in Africa, Central and Southern America, and in Eastern Europe. This echoes the concerns we had 2 weeks ago on these calls, that a lot of the pressure will now be moving to the emerging world. It was also a week where the Trump White House widened its guidelines or description of guidelines for the opening up of America again. Trump adopted a 3-phase program, which we looked at a couple of weeks ago in outline. We now have a clearer picture. He's looking for a 14-day period of improving symptoms and cases, and a position where hospitals are ready to treat all patients without crisis, and there is robust testing. He gives flexibility state by state to their governors and to the regions. Once those initial gating criteria have been met, he sees 3 phases for the opening up of the economy. In phase 3, you basically see normality. Even the vulnerable can resume interactions, and there is low risk to the general population. But in phase 1, the social distancing measures are removed only very gradually. For example, the vulnerable should shelter, gatherings of 10 or more to be avoided, and telework still for the majority of businesses. This creates a problem. It was elegantly shown in a presentation from Tony Blair's Institute for Global Change. Imagine an economy that is suffering from the virus with 500,000 deaths likely if you do nothing, that's point 1. With limited normalization, that comes down a little bit to 300 or so. With full lockdown, it drops sharply. But that has tremendous implications for the underlying economy. And you can't easily go back to 3 without risking the virus re-entering the workforce and the wider population. So we need a road from 2 to 4. We need a sustainable exit strategy with containment, with shielding, with lots of subsidiary measures. So that is the riddle that administrations and governments around the world are trying to solve. It's urgent because the economic data, I'm afraid, is getting jaw-droppingly worse. On the left-hand side, I show the business surveys for the UK and Europe. The top line is Europe, falling from the mid-50s, which imply expansion and a number over 50, to a staggering number of 31. In the UK, the figure fell to 12.9. That reflects the very high proportion of services which have been hit particularly hard. Indeed, in a recent ONS, Office of National Statistics survey, 24% of UK business had said they had temporarily ceased trading, and a staggering 94% said they would be applying to one or other of the government schemes. So the load on the exchequer is extraordinary. Across the Atlantic, the US reported another shocking week of initial jobless claims. Now, 4.4 million, it was slightly better than the previous weeks. But if you add the 5 weeks of claims to the pre-corona unemployment level of 5.8 million, you come out with a staggering 32 million unemployed, or 19.5% of the workforce. So you can see the urgency to move to some sort of a managed reopening. Our 2 key indicators that we're looking at are still holding in there, although they have worsened since we talked last week. My first one on the left is the five-year forward US inflation rate. That is expectations for inflation 5 years from now. When that dips too far, there is a risk of a depression rather than a recession as deflationary forces get a grip. That has bounced, as you see, but is hovering in at around about 1.4%, so not crisis level yet. The other indicator that we're looking at is the spread of Italian bonds over German bonds, to give some idea of how stable the Eurozone is under this intense economic pressure. Now, that peaked earlier in the week in the run-up to the Euro Council meeting yesterday, but has since come back a little bit. It's still at elevated levels, but it is moving in the right direction. And this was relatively encouraging on slide 8, because while the European Council meeting didn't result in a huge breakthrough, there was really positive signalling on solidarity, even some warmer words from Prime Minister Conte of Italy. The Europeans are looking at 4 programs. One, the ESM, you remember that from the last crisis. It has a great stigma of application and an idea that conditionality will be tough. That's been relaxed. Secondly, a program to mitigate unemployment risks. Thirdly, additional money to the European Investment Bank to help bank lending. And fourth, this elusive recovery fund, where work does seem to be in progress. On the right, you can see why this is so urgently needed, because Italian debt will spiral. On the IMF numbers, we rise to about 130% of GDP to something around 150. Our back of envelope numbers, which let's look at the sharp contraction growth next year and the rise in debt, show the numbers could reach 170% or more. And without European help, that is not sustainable. The third challenge we've had this week is a collapse in the oil price. It's a little bit complicated on slide 9, left-hand panel. There are basically 3 measures I put there. In dark red, the WTI spot. That's the US oil price where surplus supply is at its apex and storage is in high demand. That technically fell negative last week, which is an extraordinary concept, a negative oil price. If you move up one line to Brent spot, that's the European price priced out of London, which is used by much of the rest of the world. That collapsed but stayed positive. And if you look at WTI 12 months forward, in other words, what the futures market's telling you, that's sat at about 31. So this negative price doesn't reflect reality, but it does show the extraordinary tensions in the oil market today. And on the right-hand side, you can see oil market volatility peaking at levels that have been inconceivable in any orderly market. And while I think stability is returning, this is another shock the world economy and financial markets have had to deal with. So what does this mean for the future? Well, against this backdrop, surprisingly, equities have continued to rally. The world index was 33% down at its worst point. As of last night, it was 17% down for the year to date, so almost a 50% rally from low. Unusually, low-risk assets were rallying as well, gold and UK gilts. And this makes us a little bit nervous that quite a lot of the move is a sugar rush from the expansion of central bank policies. And on the right, I've shown the extraordinary growth in the Federal Reserve balance sheet. You see the same for the Bank of England or the ECB as these emergency measures come into place. And of course, that supports asset prices. So despite the rally, we remain a little bit cautious short term for 3 underlying reasons. 1, managing the exit from lockdown. 2, the economic drawdown. And 3, the aftershocks in areas like oil. But in the longer term, we're becoming a little bit more optimistic. 1, ultimately low oil prices are good for the emerging world. We badly need it. 2, it looks like we're fumbling towards a real solution in the Eurozone. And 3, as we experiment with these managed lockdown plans, perhaps we will have a combination that leads us to lower infections, but a gradual relief from this economic drawdown. Thank you.